Pick stocks like Warren Buffett. That is what I'm going to teach you today. A lot of people hear a lot of things about Warren Buffett, but I'm going to walk you through the methodology. And at the end, I'm going to tell you my favorite stock that follows the sort of Warren Buffett valuation method. So let's start. We can break down the Warren Buffett stock selection method in three basic parts. One is value. So what do we call value? That's the earnings yield of the stock. So a stock may have 20 PE, that would be a 5% earnings yield, or 30 PE, that would be a little over 3% earnings yield, or 15 PE, that would be closer to 7%. Okay, so that's the number one question. Not the most important question, though, but it is a question you got to answer. Number two is growth. So essentially the return you're getting over time on a stock is the earnings yield plus the growth over time. So when I'm talking about growth, I'm looking at 10 or 20-year periods. And this is what Warren Buffett has done for his whole career, which has worked phenomenally for him. So growth is not what you think growth is going to be for the next year. It's what growth you think is going to be for 20 years. So this is why Warren Buffett has picked stocks like Coca-Cola and Apple, because he can project their earnings growth over a 20-year period. He knows that, for example, the diet soda market or the soda market in general worldwide is going to grow by a certain amount. And that's pretty accurate over a 10-year period. So he knows that Coca-Cola has a moat. It's going to have the lion's share of that market, and he's going to get that growth. Same for Apple. They know the cell phone market is going to grow a certain amount, and he's going to get the lion's share of that. The third that nobody really thinks about is the predictability, or what I would call the variance of earnings. So how stable are the earnings and the earnings growth? So for example, if you have a company that's really susceptible to global macro events, that is going to fall apart in a recession, that might be taken over by other companies, their sales. These are all factors that may be beyond the company's control that could dramatically change their profitability. That means they're going to have a lot of variance to their earnings and their earnings growth. Well, if you have too much of that, there's a very real risk. Now, let me go back to value for a second, because people look at a PE and the forward PE of a company, and they think, oh, well, it's trading at a 10 PE. The stock's just dropped 50%. It was a 20 PE, now it's 10 PE. I would be very careful of things like that. Usually when a stock drops 50% and goes from a 20 PE to 10 PE, it means something's going very wrong. So don't be fooled, because oftentimes you're not going to see it in the news releases or in the predictions by brokers. You won't see it. You'll see it later when it's too late, after you buy the stock. So what you want is a company that's steady, trades at a steady PE. So that's a key. Don't get fooled by a sudden drop that makes it look like the company has real value. Now, Warren Buffett has bought stocks when they've had a problem, but he was able to really, assess the problem and go from there. Growth. So it's really hard to look at a company's growth from the standpoint of taking over market share from their competitors. You obviously want a company that's really well run and you think they're going to take market share. But a lot of times the growth is going to come from the industry itself growing. So if you're in a shrinking industry, well, you have a real problem. If you're in a growing industry, that's much more reliable information than a company taking market share from its competitors, because that may ebb and flow from year to year. Whereas the growth of an industry, like the cell phone industry, like the plastics industry, like the soda industry, these are all things where they have a very predictable growth rate over a long period of time. Warren Buffett's always looked for like a 20-year period where he can predict the growth rate. Now, in terms of predictability or the variance, what do you have to look at? You have to look at things like corporate governance, or what I like to call it, are the insiders going to loot me? So you want to look at things like, are the executives overpaying themselves? Is there a majority shareholder who can do something damaging to you? So you want to see that the company's interests are aligned with yours. So that's one of the big factors. You want to look at their macro exposure. So, for example, regional banks always often trade at a good yield, but the fact is that they're very susceptible to macro changes that they can't control. So there's huge variance. Whereas somebody like Apple or Coca-Cola, they have huge margins, they have huge market share, what Warren Buffett would call the moat, and they're not going to get knocked out of their position. They're going to make roughly the same amount of money, give or take. If there's a recession, they'll make a little less. If it's a booming economy, they're going to make a little more. But they're going to basically have the same profitability margins and year after year, decade after decade. And as that industry grows, they will always have their share of that growth. So that's a big factor. Warren Buffett often talks about staying within your circle of competency. What he means is, do you really understand how this company works? Do you understand the business? And what that really boils down to is these three things: value, growth, and predictability. Are you really able to assess it? Or are you just looking at a report by a broker? Unless you really understand the business, you can't assess these three things. And that's how you're going to get to the point where you're going to find stocks that a lot of people are missing, even small stocks that you can hold on to and make 100x returns on. Now, I promised you that I would give you my favorite pick. And my favorite pick is EPD, Enterprise Products. Why do I like EPD? First of all, I followed it for many, many years. And I used to run an oil infrastructure fund, and EPD does energy infrastructure. So they typically handle NGLs from the time it's taken out of the ground to the time it's used by the customer. They do fractionation, they do processing, they do pipelines, they do everything. These are big plants. There's a lot of infrastructure cost, and they're very, very good at it. So a lot of the NGLs, people think it's like oil. It's not. It's actually the feedstock mostly for the plastics industry. And that is growing at probably a 7 or 8%. And the Iran war has actually helped EPD because a lot of companies around the world are looking for security of supply outside of the Middle East. And so they're looking to the United States for feedstock for plastics, and that's US NGLs. And EPD is the biggest player in that field. So that looks like a very good company. Their debt is like, their infrastructure builds are very long term, and they need to borrow money to get the maximum leverage. Their average debt is 17 years duration, and their interest cost is 4.7%. So they have a lot of stability in their borrowing. All their revenues come on long-term contracts. Take or pay means the customer, even if it doesn't want their service, has to pay for it. They also have inflation things in their contract which boost their returns if there's a higher inflation. Essentially, their returns are protected for years and years. They're usually their contracts are over a decade. So once they build their projects, their revenue is guaranteed, and their profitability is guaranteed. And they do a very good job of it too. So this is a company that I would say has locked in contracts, locked in debt. They couldn't lose money if they tried. And as a result, they've raised their dividends 28 years in a row. And, they grow almost every single year, even during recessions, even during an oil crisis. Now, when we're looking at the Buffett methodology, we have these three levers. Earnings yield, so that could be anywhere from, let's say, 3 to 7%. In the case of Apple, for example, it's 3%. For the case of EPD, it's more like 7%. Then there's growth. You want a company with good growth. So I would say growth between 7 and 10% is good. So you get the combination. If you can get a company that has a 7% earnings yield and a 7% per year growth that you can look out 10, 15, 20 years, well, that's a company that you're going to make a fortune on. And then if you can be sure that they're going to maintain that growth and earnings through good times and bad, then that's the perfect scenario. And that's EPD. So I've owned EPD for years, and I think that's the best stock that I can think of. So in conclusion, you have to look at those three factors: value, growth, and predictability. And the most important is probably predictability.